The Morgan Report with David Morgan. Discover how to build and protect your wealth at themorganreport.com.
David Morgan of The Morgan Report for the week ending August 15th, 2026. Today, August 15th, marks the 55th anniversary of one of the most consequential monetary decisions in modern history. On August 15th, 1971, President Richard Nixon announced that the United States would temporarily suspend the dollar's convertibility into gold. Foreign governments and central banks could no longer exchange their dollars for U.S. gold at the official price of $35 per ounce. Like many government programs described as temporary, it became permanent. That decision ended the final restraint on creation of dollars. From that point forward, the dollar was backed primarily by confidence. Confidence that the United States would manage its currency responsibly. The record since that speaks for itself. Dramatically greater government debt, repeated financial crises, persistent currency debasement, and an economy increasingly dependent on credit expansion and central bank interventions. Gold did not suddenly become more valuable. The measuring stick became progressively less valuable. And that brings us to today. Gold buying has cooled in certain important areas, particularly compared with the extraordinary buying we saw previously. According to the World Gold Council, identifiable investment demand, excluding over-the-counter activity, fell to 262 tons during the second quarter, down 51% from the first quarter. Gold ETFs lost approximately 45 tons, while bar and coin demand fell from an exceptional 477 tons in the first quarter to 307 tons in the second quarter. Jewelry demand also weakened under high pressure of high prices. We need to be precise. Overall gold demand, including estimated over-the-counter activity, was essentially unchanged from a year earlier at approximately 1,270 tons. Again, over-the-counter buying remains strong. Central bank buying presents a mixed picture. Purchases slowed substantially at the first quarter, resulting in weaker first quarter half totals since 2022. Yet, central banks returned forcibly in the second quarter, buying approximately 290 tons. So the better description is not that gold demand has disappeared. Some of the speculative urgency has subsided. High prices have discouraged jewelry and retail purchases, and ETF investors have taken money off the table. But underneath that, central banks and large OTC buyers continue accumulating. Meanwhile, the Federal Reserve has left its federal funds rate target unchanged at 3.5 to 3.75% in July. Interestingly, 3 members dissented because they preferred to raise rates and not lower them. That tells us that the Fed remains trapped between inflation on one side and an over-leveraged financial system on the other. Rates are not extraordinarily high by historical standards, but they are burdensome when measured against today's enormous debt load and the servicing of that debt load. Finally, I want to address market manipulation. The courts and regulators have established that spoofing occurred in the precious metals futures markets. Traders placed orders and intended to create a false appearance, cancel those orders, a false appearance of buying or selling pressure. J.P. Morgan paid more than $920 million to resolve precious metals and treasury market allegations, and individual traders were convicted and sentenced. However, the cases involved gold, silver, platinum, and palladium, not just silver. Therefore, we cannot say the courts punished manipulation in silver while ignoring it in gold. What we can say reasonably is that silver is more susceptible to the influence. The silver market is far smaller and less liquid than the gold market. A concentrated futures position can represent a much larger share of available silver liquidity than the equivalent position represented in gold. That makes silver easier to push around over the short term and explains the extreme volatility. Gold, by contrast, is traded around the world by central banks, sovereign wealth funds, institutions, private investors, jewelry buyers, and over-the-counter participants. It's a deeper and much broader market. That does not make gold perfectly free or immune from intervention, but arguably makes gold much more difficult to control. Perhaps the real lesson of August 15th is governments can close the gold window, central banks can manage interest rates, large traders can distort prices temporarily, but they cannot repeal monetary reality. 55 years after Nixon's temporary suspension, gold continues doing exactly what it's done for thousands of years, measuring the credibility or lack of credibility of those who issued the currency. That will be it for this week's Weekly Perspective. I will be back with you next week with another perspective.
The U.S. government debt is about to cross $37 trillion. That's not a typo. That's trillion with a T. Tariffs are being used to try and even the playing fields. Global supply chains are shifting. Inflation isn't going away. And the value of your dollar? It's quietly being drained while no one is really talking about this. The truth is, we're living through the early stages of a financial reset, whether anyone wants to admit it or not. And if you're still relying on mainstream headlines or financial advisors who just tell you to write it out, you could be blindsided when things really shift. That's where the Morgan Report comes in. For over 25 years, David Morgan has been helping investors cut through the noise. He tracks what actually drives markets, from precious metals and mining stocks to global debt and monetary policy, and show you how to protect and grow your wealth when the system is under stress. This isn't just about gold and silver. It's about having a clear-eyed view of where things are headed and making sure you're not caught off guard. The Morgan Report gives you real research, honest analysis, and strategies you can act on, even in a world of rising debt, unstable currencies, and economic uncertainty. Go to themorganreport.com today, download your free report, get informed, get ahead, and take back control of your financial future. Themorganreport.com, because $37 trillion in debt won't fix itself.